Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets. For those who are better off reading than listening, we also have a blog that we produce every week on our website, ar.ca/blog, appropriately titled That's Our Two Satoshis. All right, so what's going on in the crypto markets this week? Actually, a lot of news, not a lot of price action. Obviously, we had a little bit of a dip on Sunday night into Monday, about 10%, which was a little interesting because you still have strength in the equity market, nothing really happening in the macro world. Actually a lot of tailwinds in the macro world. Actually, you got better global liquidity coming. You've got rate cuts. The VIX is going nowhere. Credit spreads are going nowhere. Rates are going nowhere, other than potentially lower. Equities are at all-time highs. So a little interesting to see a 10% hiccup on Sunday night into Monday in the crypto markets, but nothing out of the realm of normal kind of crypto price action. What I did see last week, though, was there's actually a fair amount of interesting pieces of data and information going on right now. Most of the last 3 months has really been driven by these ETF flows and these digital asset treasury companies. But that doesn't mean that there hasn't been other news. It just isn't necessarily translating into price action. So as I was kind of thinking about just themes in general for the week, I actually just wrote down 5 random things that I found interesting this week. Number one is, Circle is in really big trouble here in terms of the equity performance. There are just a lot of headwinds against Circle here. The most obvious one being that 100% of their revenue comes from interest income, and they invest all of the proceeds of USDC. So USDC being a $75 billion asset now, they take all of the cash, that $75 billion, and they invest it into short-term treasuries and other equivalents. Well, the Fed just cut 25 basis points. So if you have 75 billion of AUM, a 25 basis point reduction in the yield that you're investing in equates to 187 million of lost revenue on an annualized basis. Moreover, the market is now pricing in 6 Fed cuts, 6 rate cuts now into 2026. So 2 more at the end of this year and 3 more into next year. So that's 150 basis points total. That's well over $1.1 billion of lost revenue for Circle. That's not great. On top of the fact that Circle's stock, you could argue, is already incredibly expensive, trading at 15 times revenue. That means that if you put that same 15 times revenue multiple on the lost revenue that they're expected for next year, you're talking about $17 to $18 billion of lost market cap just because of rate cuts alone. The entire Circle stock is only a $30 billion company. Well, I say only, that's incredibly expensive based on their revenue. But as a $30 billion equity market cap, and you're about to lose $17 billion in interest income as a result of these rate cuts over the next year and a half, that's not good. I would not want to be a Circle shareholder right now. On top of that, you have a lot of pressures on USDC as well. The race to vertically integrate across crypto protocols continues everywhere. Basically, there's only 3 things that matter in crypto protocols, right? You got to have the actual layer 1 protocol itself. You got to have a good DEX, decentralized exchange, and you have to have a good stablecoin, right? Anybody who started as a layer 1 protocol is now trying to build their own DEXs and stablecoins. Anyone that started as a DEX is trying to build their own layer 1 and stablecoins. Anyone who's started as a stablecoin is trying to build their own layer 1 indexes, right? It's happening across the entire industry. So you've got all this competition coming on the stablecoin front from these DEXs and layer 1s, on top of the fact that as a result of the Genius Act coming, you now have banks and brokerages getting involved, right? I don't think it's a coincidence that the 2 underwriters of the Circle IPO were Goldman and, not Goldman, were Citi and JP Morgan, and both have announced stablecoin plans in the future. Think about it, right? You're the underwriter of Circle. You go through their books, you do the road shows, you realize, oh my God, this is the easiest, most simple business in the world that generates a ton of cash. Why don't we replicate it and do the same thing? On top of it, you got Hyperliquid, who are 6 billion of USDC resides, coming up with their own stablecoin, right? There's an example of an exchange building their own layer 1 in their stablecoin. Now you got Solana community saying, well, this is crazy. Why do we have so much USDC on Solana? We could just have our own stablecoin. So there's all kinds of pressures coming on Circle. This stock looks cooked, in my opinion, for the foreseeable future. Next random thought, Metamask announcing that they're going to issue a token. We've actually seen a flurry of new token launches this year and announcements for more coming as a result of the new U.S. administration and the new SEC and other regulatory bodies, as well as some of the legislation coming from Congress. I thought it was interesting that Metamask announced finally having a token. and that they would soon allow trading of perpetuals from the wallet. So for those who don't know, not only is MetaMask a wallet, but you can directly trade on spot exchanges from your MetaMask wallet, and MetaMask generates a pretty hefty fee for that. If they start trading perpetuals through there as well, it's obviously another big revenue boost for MetaMask. They claim to have 100 million users, about 30 million monthly active users. That's a lot of people that are going to expect an airdrop here from this MetaMask token. But it begs the question, why does a wallet provider need a token in the first place? And I saw that pop up a lot on crypto Twitter. And I think it's a valid question, but it completely misses the point. Clearly, a wallet provider does not need a token in any way, right? The handful of businesses or protocols that actually need a token are those that have proof of work or proof of stake, right? Very few tokens are actually, protocols that need a token at this point. Most of the tokens in the market now are not from the model of needing a token to secure a network, but it's rather using a token properly as a kind of hybrid vehicle that's part quasi-equity in the growth of the business and part rewards for using the product. That's really the future of all crypto, in my opinion, right? Binance pioneered this model using their BNB token as part quasi-equity, meaning you got 20% of the profits of Binance, and part rewards token, meaning you could use the BNB token to get lower fees on their exchange and to use as collateral, et cetera. That was the first real hybrid model, right? This kind of pass-through token that was part quasi-equity, part rewards. And it's no secret that BNB has been one of the best performing tokens in history, right? Coming under 10 cents and now trading at $1,000. Hyperliquid and Pump.Fun are other companies that have employed the same model, right? Hyperliquid and Pump.Fun have made the BNB model even better. Instead of only giving 20% of the profits to the token holders, both Pump and Hyperliquid are giving almost 100% of the revenues, right? Both are in the 97 to 99% range in terms of revenues created by the business through trading fees, giving it directly back to token holders through buybacks. So I think MetaMask will be in the same camp, right? This is where we're headed. And quite frankly, this is not a hard concept to understand. At least it wouldn't be a hard concept to understand if there just wasn't so much bad information out there coming from the exchanges and the VCs and the crypto media who are purposely hiding the fact that tokens are no longer just a way to secure a network. It's really a way to express upside in the business of a company that you support and use. I think the Mask token will probably follow in the footsteps of other hugely successful businesses like Pump and BNB and Hype and others. And I think this is where we're heading just in terms of everything in crypto, is that good companies with a lot of users are going to start using a token the right way rather than this sort of fake network security stuff that most crypto participants have latched onto for most of the last 5 years. So I look forward to the Mask token being another successful example of this. On the same in the same breath, the Uniswap token is the exact opposite of this. I think it's hilarious. Hayden Adams, the founder and creator of Uniswap, has always been a little tone deaf in the way he tweets and communicates. But this last week, it was amazing that he put a tweet out there that said, "It's always funny to see people bear post Uniswap. Meanwhile, volumes are at all-time highs," and a bunch of other data supporting the Uniswap. And I thought it was funny because, yeah, Uniswap, the protocol, is killing it. Nobody has ever said otherwise. It's a great protocol. It's a great user experience. They've managed to be, number one in decentralized spot trading really since existence. No one has ever bear posted Uniswap, the protocol. We're bear posting Uni, the token. It is the most useless token probably in crypto history. It's a complete farce. There has been multiple attempts through governance to try to turn on a fee switch where a portion of the revenues would then go back to token holders. They've all failed largely because of Hayden himself voting no, and as well as A16Z, the biggest VC in this. It's quite frankly, it's a crime, in my opinion, that these guys are continuing to funnel money into Uniswap Foundation and Uniswap Labs, right? The equity holders of Uniswap are still getting paid while token holders get nothing. I understand that Uniswap is one of the most successful airdrops in history. So, you shouldn't look a gift horse in the mouth, because on average, people got $1,400 per wallet for just using Uniswap. But that's neither here nor there. At this point, you have a fiduciary responsibility, if you have a token, to support your token. And Uniswap does nothing to support the Uni token. Not at all. It's insane that absolutely none of the revenue created by Uniswap protocol from the $1 trillion plus of volumes that they do accrues back to token holders. In today's market, where all we're seeing is good companies with revenue and buybacks succeeding, and all we're seeing is a changing regulatory environment and investor demands where this is what people want. It's insane to me that Uniswap still hasn't adopted a fee switch. and started to pay back token holders in some way, shape, or form. So I think it's, like I said, to me, it's almost criminal that Uniswap continues to hide behind incorrect legal and regulatory assumptions, as well as their VC cronies. Either turn on revenues and buybacks already, like every other successful token, or don't bother having a token at all. It's that simple. Just because you airdropped a token and created a token doesn't mean you get to just sit there and not support it, right? We've seen tons of examples of that, like DYDX, that have gone by the wayside for making similar foolish decisions. So on the one hand, you got Metamask coming, probably does it the right way. On the other hand, you have Uniswap doing it completely the wrong way. Like I said, a lot happening in the markets this week. Another tweet that I actually latched onto this week was around Solana. Somebody tweeted out, a user by the name of John Wang, that Solana market cap is now 2 times higher than the all-time highs reached in 2021, but the price is roughly the same. And for those who don't know, I mean, this is normal course of business in crypto, which is that inflation is just a silent killer. And I actually think it's kind of ironic because there's so many people in crypto who are constantly talking about the US dollar inflation and loss of purchasing power. So everybody understands that the dollar is no longer nearly as valuable as it was because of inflation. Yet here they are talking about Solana and Ethereum and all these other layer 1 protocols that have massive inflation schedules and can't seem to understand that, yeah, market cap goes higher while price doesn't go higher because all you're doing is adding to the supply of tokens. So there's 2 dynamics of why Solana and some other protocols can have market cap growth without having price growth. One is the inflation. Like I said, Solana's started at 8% annually. I think it's down to 4.5% now. But still, I mean, 4.5% inflation on a $100 billion token. That means you have to create $4.5 billion of new demand for Solana every year just for price not to go down, right? Bitcoin's the same way. Obviously, Bitcoin's inflation rate is much lower now, but it's the same thing, right? Bitcoin was the anomaly. It's very rare for something like Bitcoin where it has massive inflation and no organic product or demand or revenues to go higher. Solana and other layer 1s are the same. This absurd inflation is killing price growth, and it's why I think that the fat protocol thesis and all these other crypto natives who continue to talk about layer 1s being so important and so great investments, I think they're just wrong. You can't have a great investment when you have inflation this high. But the other reason that Solana's market cap is way higher, even though price hasn't gone higher, is just because market cap in general is a flawed metric. We've talked about this a lot. We've written a ton about it. You've probably seen Arca's adjusted market cap methodology. Basically, every other industry in the world has this right, and crypto has it wrong. And I'm looking at you, CoinMarketCap and CoinGecko, as well as exchanges like Binance and Coinbase. Like, it's insane that you guys continue to just put misinformation out there. Market cap, as stated on any of these sites, is really not market cap. It's float, right? They're using market cap and float incorrectly. In the traditional world, your float is what's actually tradable, but your market cap actually includes other tokens that are out there in the market but just aren't tradable yet. Things like locked tokens, things like team tokens. So the reason the market cap of Solana has doubled is not just because of inflation. It's also because the market cap was not taking into account a ton of tokens that were owned by VCs that have since unlocked into the market. So had you used the adjusted market cap methodology like most people should, that's the number to use. You don't want to use market cap, which is just float, because that underrepresents the supply. You don't want to use fully diluted value or FDV because that overstates supply. The right number to use is adjusted market cap, which talks about every single token that's in the market, whether it's tradable or not, but doesn't include tokens that sit on the company's balance sheet, right? This is how the equity market operates. You would never look at fully diluted value in the equity market because it doesn't make sense. It's stupid. Companies can issue as much stock as they want. And you would never look at just float because it's irrelevant. You have to also look at stock that's owned by insiders and owned by VCs, even if they're locked. So it's really just misleading using market cap and FDV. And I hope others start to look at Arca's or adjusted market cap methodology and realize that no, Solana's market cap didn't double. It's just that it was being incorrectly underreported for years and fooling the majority of investors. And I think the onus, again, is on CoinMarketCap, CoinGecko, exchanges to stop doing it wrong and do it right so that investors don't end up with a situation where market cap doubles while price goes nowhere. And lastly, fifth thing that I thought was interesting this week, you may have saw that Base, Jesse at Base, the layer 2 on Ethereum that's owned by Coinbase, is going to be issuing a token soon. I wrote over a year ago, actually almost 2 years ago now, I talked about that Base will eventually have a token, but it'll be really interesting because it'll probably go to Coinbase shareholders since Coinbase owns Base. Essentially, if you believe that a layer 2 token should have a couple $2 billion valuation, which is another story, I think that would be crazy, but they probably will trade there because things like Arbitrum and Optimism and other layer 2s trade at inflated valuations anyway. So if you assume that you're going to create a couple $1 billion of value through this base token, that really should be a special dividend to coin shareholders. I don't know if it'll play out that way. I think it'll be an interesting legal battle to see how Coinbase and Base do this. Base is probably, they're thinking in their head, they're coming out there saying that, the Base token is going to have a potential to advance decentralization and expand creator and developer growth and all the technical, stuff that would be a way to sell this token. But from a financial standpoint, one, this L2 works perfectly fine without a token already. Another example of a network that doesn't actually need a token. And two, even if it did have a token, nobody wants to buy layer 2 tokens anyway. They're worthless. Look at Arbitrum, look at Optimism. Like, it's a pointless token. It does nothing. It creates no value. So the only reason to issue a token from Base, in my opinion, would be to issue it to shareholders. And I think if shareholders don't get the Base token, there's going to be a pretty big legal battle over where that value goes. So this has nothing to do with Base, the protocol. The protocol itself is great. I think Jesse and team are doing great. I think the Base protocol is interesting. I think there's really cool stuff being built on there. It's just, again, when you have this competing interest between shareholders and token holders, it largely doesn't work. And I think this is going to be another bad example of using a token. And it doesn't surprise me coming from the Coinbase team here. So we'll see how that plays out over the next couple of years here, whenever that Base token gets launched. But again, I think the takeaway from this week is price action has been sort of down to kind of boring, but there's actually a fair amount of things actually happening in the market, and we look forward to seeing how these things play out and where investment opportunities come from it. So that's it for this week. Appreciate y'all joining. We'll be back next week, and that's our 2 Satoshis. Thanks, everyone.